I was just looking online. You guys have bought $200 million in real estate in the last 90 days.
Yeah.
Is that right?
Yeah.
That's a lot of real estate.
Yep.
So talk to us about like what that was. And it sounds like you're pretty bullish on the market right now.
I think you got to back up and say why. Like, why now? And what? Obviously, I've been doing this for 25 years with my current company. And so we've had an opportunity to mess up and buy wrong in the cycles and not buy during the cycles and all that stuff. Doing things right. Also 20 some years of doing things wrong. So the signs that I saw when interest rates went up a lot, and there was a bunch of things that happened. One, people pulled back, construction pulled back, investors pulled back. It kind of flushed out mistakes and things that people had made in the last few years, whether it was underwriting or management or buying or markets, or it doesn't really matter. So all that stuff I knew was going to expose itself, and it's starting to. So that's one. Also, new construction pulled back because when interest rates go up, it's harder to make those deals pencil. Plus, costs went up and all that stuff. So you have to go back and take a look at the last few years and just acknowledge the fact that the people that did a lot of business during that time, they're going to have some rough water, and so you're starting to see that, right? And so what you want to do is you want to position yourself after that,
Yeah.
So that's all. That's why now, So we started seeing cracks late last year. How do you raise money in a market that's pulling back, right? So that was one obstacle. Not a tough one, but still an issue. It's not as easy as, like it used to be. So all those things. And so you got to put all those ducks in a row last year, which we did. And so what we're trying to do now is we're trying to buy assets that are in distress of some sort. And maybe that's below replacement cost. Maybe has occupancy problems. Maybe it has, capital problems. Maybe it has issues with the lender. It doesn't really matter. I think we're at the beginning still of more to come. And so we're just trying to get our whole team in place. And so I think by May 7th, we'll have closed about actually $503 million. By the second week of May.
Wow, that's amazing.
Yeah.
And how big you were $2 billion before, or 1.5?
Yeah, I don't know. Yeah, somewhere in there. Yeah, it's probably in the twos.
So it's really interesting from a capital perspective, because one thing I've noticed is that looking back, the worst time to raise money from a deal perspective was the easiest time to raise money.
Correct. It always is.
And when now we're seeing some things that look pretty attractive, but it's harder to raise money. And everybody, talks about, we want to be a contrarian. We want to do this. What is it about
they say that, but they aren't.
But they aren't. Yeah. So what is the psychology around that, you think?
If you got into the business in the last 10 years, then this time right now is really shocking. But if you've been around it, like a lot of folks in this room, it's not. It's just a correction, over, your career. And so for me, the signs that, when you got 2, 3, 4 times the amount of people bidding on stuff, they're doing hard money day one without even looking at the property and not doing inspections and shortening their inspection periods and all that stuff. Those are all red flags that people just accepted.
Yeah.
And because they thought next year was going to be better than last year. So what they did is they compromised the basics that got them to where they are, if in fact they had a longer career, for a short term, what they thought was going to be a gain, and it wasn't a gain. So they're just basically giving that back and then maybe some. So I think we were bidding every week on stuff, and we were slowly falling down the list of not even close to best and final. First we're at the top, then you're somewhere in the middle, and then you're at the very bottom. And I was just unwilling to stretch. And so then what happens is, you had a lot of these groups that were actually teaching people how to raise money too, at the same time. And they were releasing, release the herd, go have them go out and raise money from all their friends. And that all just pushed prices even more, because they had networks and so that's all, working its way out right now, positively and negatively. And I think that there's nothing wrong with that education, by the way. But I know a lot of people that raised money and didn't know really what they were buying. Or who they were placing it with, really. Like, they knew them, but there's a conservative approach, I think, with real estate that you have to keep, and you should never waver off of it.
Yeah, sticking true to your core values and what's important, and that, sharpen the pencil, but not too sharp, and not trying to reach for anything, like you said, because once you've been through, and we've had this conversation recently where we lost some money in a couple deals, and you've lost money, you've made money, and just when you can share, but it gives you this education and you learn. And that's where sometimes it can be positive. So I guess going forward, I think of you, obviously you do a lot of different assets. We're going to talk about Limitless. How many of you guys have been to Limitless before the event? Yeah, it's going to be in August, incredible event in Dallas. I'm going to be there this year again. Yes, I'm going to be there. But just really, like, when you look at, when I think of multifamily, I think of you, because that's like, yes, your child, really what you do. What do you see nobody has a crystal ball, the next 3 to 5 years? I mean, obviously you're buying, so it's gone from being an in-favor asset to a very somewhat out-of-favor asset right now. So where are you kind of seeing things, interest rates and valuations and going forward?
Well, let's take a look at why it's an out-of-favor asset. It's an out-of-favor asset because because prices have adjusted down to where I think they should be. Now let's take a look at why I think it's a good asset, because we're still severely under supply. We don't have enough we don't have enough units.
Do you think it's 1 million or 7 million? That's the number.
I don't, sure. I know I've seen numbers all over the place. I tell you, if you go back and look at, from 95 till about 2007, under Clinton and Bush, they had 2 presidential acts. The first one was American Home, everybody needs their own home. The second one was American Dream Down Payment Act, something like that. And they basically were taking people from rentals into home ownership, and it pushed the home ownership rate all the way up to 69%, 69.2%. And that popped around 2006, 7, or somewhere in there. And then, but on the other side of that, that means that 31% was rental, 69% home ownership, 31% rental. Now that all went all the way back down. And during that period of time, what happened was people moved out of single family back into rentals because for they call it the GFC during that period of time. That's actually what saved the rental market. So people moved, and so we had this shift of people back over, and so that happened. We all know that happened. Was there 6-7 million people went into foreclosure, I think, and they went somewhere, right? Whether it's a rental house or a condo or moved in with somebody or whatever, but they've shifted over. Millions of people moved over to the rental side. And then that took a few years to wind out. Okay. And then, of course, it took a few years to correct. So by about 2013, 12, 13, 14, that was actually still winding. It was still unwinding. And the point is that from the great financial crisis, whether it's 2007, 2008, for that 5 or 6 year period, not a lot of lending, not a lot of building, not a lot of stuff happening because there's all these units. And so what you have is you had a period of time from the beginning of the great financial crisis for almost over 10 years where there wasn't a lot of new construction. And there was a little over 2 million new people added every year. Okay, just population growth, just, people being born minus deaths plus immigration. So if you just look at the math, you can see that we're undersupplied. So when you say 1 million, 7 million, it's probably somewhere in the middle from what I've seen, because some people measure it by affordable housing. And also that's all one big category. So, but maybe you're in a market where, like downtown Phoenix, where there's too many units right now, and you can rent something for 4 months free on a 12-month lease right now. Just go look. or the west side over by the stadium for those of you who are local. So you wouldn't want to buy there because there's a lot of units that get dumped there. Now, fast forward to Tempe, not a problem. Scottsdale, it's not a problem. Gilbert, not a problem. Chandler, not a problem. So, so it's all, as you know,
Pockets.
that's just here. But so you're going to have pockets of pain based on all that supply. And so, but the reality is that during that 10-year period, there wasn't a lot of new construction across the U.S. And so that demand is starting to show up. And so everybody got all this rent growth from, and they're like, look how smart I am, 6, 8, 10, 12% rent growth. It wasn't them. It was absolutely 100% the amount of people that needed apartments at the time when people got into apartments.
Yeah.
That's what happened.
That's what happened. Yeah.
Yep.
So earlier, Devon had a great presentation. He was sharing about he hadn't seen a deal go bad in real estate except for the debt structure.
Yeah.
So let's talk for a little bit. I know you were doing a fair amount of new construction in this area as well, because you could basically build for you're doing. Yeah. So I know that's variable as well, but talk to us about, like, as an investor, deals that are fixed rate versus, like, some people doing kind of a hybrid where it's like you get a 5-year, or it's like this with caps and additional income up front. But I guess when an investor, like a lot of passive investors here, what do you look for in a debt structure if you were to invest passively in a deal, and the manageability of that?
The most obvious one is exactly what Devon said. People want to blame interest rates as the reason things went bad. But I had a conversation yesterday with a group where they were trying to manage it in-house. They bought the wrong property. They paid too much. Their occupancy's in the 70s and 80s, and they're not managing the expenses well. And there's a zillion problems, right? But what went wrong? The debt. So, you can't just mask it. So what you always want to do is you want to do fixed rate debt, well underwritten expenses and income. And that's it. And so if you're cash flowing today, what are the things that can mess that up? Not the debt. Either expenses are underwrite those, or you're too aggressive on the income.
Right.
So if you understand those two things, you can mitigate most things, right? If the debt can become a massive liability if you don't fix it. So we just locked the deal. You just want to hedge that debt and then make sure that the syndicator isn't trying to be too pie in the sky on their underwriting and their projection.
Yeah, it really seems like a lot of times we can be very like, oh, this return of 15, 18, 20%. Oh, looks at newer investors was always better, right? Versus a 12 or 14 or whatever. But I notice great operators tend to just kind of under promise and over deliver, right? You just kind of come at it from a way that we do this a long time, and let's be here. Let's try to outperform.
I sold a building in Houston. There was a small building, like 140 units, let's say. And we put it out to market and a syndicator tied it up. Now, I'll give you a backstory. So a year before we put it out, I went to Ross and I go, and let's see if we could push the rents. Yeah, it was kind of near downtown Houston, inside the Beltway. And so we renovated 4 units. And I spent like $8 or $10,000 per unit in renovating them. And then we put them out into the management, which we managed it. And I said, do you think that we could push these rents? And they tried, like, for months, just try to, and they were like, it was minimal, like 20, 30, $40 for, so I was like, clearly the math doesn't make sense. You can't spend $10,000 a unit and get $30 or $40 a month. So we pulled back and said, we're not going to renovate this thing. So let's just sell it. So we listed it. And I happened to be on the list of the syndicator that tied it up.
So you got some other.
So I got the business plan on my own deal, which was awesome. And guess what it said?
What?
Just guess.
Oh, I was going to say, we're going to come in under market rents. We're going to put this money in. It's going to come out. And it did not work the way that they planned.
Value add operator, can't operate a building. And on the docket says, well, it was close enough. Occupancy, poor management, rent growth like crazy. value add opportunity. They're overspending on expenses, all the stuff that you would expect. So that goes on.
Yeah. Yeah. That does. You said something, and I've where, Warren Buffett says the best holding period is forever.
Yeah.
Right. You just hold forever, and then you can have refinances, and you do, or there's a infinite, but that's not the common. And the other side of that, and the part where I've come from as well, has been like, but if you do the value add and you sell sooner, then your IRR is higher. But then you've got to, like, I'm saying, if you finish year 2 or 3, now, I'm saying this is what my thinking has been before, where it's like every year you hold it longer after you've done some big value add, meaning you've renovated all the units, you've renovated 80% of them. But there's a lot more risk that you introduce when you're doing value add, right? Your eyes got real big there when you.
Well, I've done 3 value adds on one deal that I've owned the whole time.
Yeah,
you can value add, which is awesome, for some equity. And then you can refinance it and sell it even. And then soon it'll need value added again.
Yeah.
So, or you can hold it and refinance and value add, and then refinance and value add. Like, you can do that.
Yeah.
Or, like, there's so many options. I've always found that each time I sell, I'm frustrated I can't find a good deal. So I'm like, well, why wouldn't I just keep the one I've got, like, and
know the deal,
recapitalize it through different ways.
And the skeletons in the closet, what that deal holds, and you can
or you don't. And those are the ones you exit. Right. So sometimes you buy stuff that you're like, we don't like this, or, that it has too many 1 bedrooms or whatever it is. Like, there's things that you find later that, the market doesn't give you back. So those are the ones that you kind of move on from. But the reason why people do that is because the market focused on raising money away from the fundamentals of the deal. So that's when you started seeing these crazy numbers given away on the equity.
Right. Yeah.
The only way to pay that back is to sell.
Yeah.
Right. You just can't raise money at that double digits.
Yeah.
You can't. And because the property will never produce that in year 1, 2, or 3, or 4. You'll never ever get there.
Well, and this has been a learning for me, right? So as an investor, and even as somebody who raises money or operates as a part of that, it's so important we all keep learning, right?
So if you want to see how you turn a piece of dirt into $87 million, let me show you how we're taking 19 acres and turning it into 312 units. And you can watch that video here.